Hi everyone. In this video, we're going to see what qualified small business stock or QSBS and charitable remainder trusts or CRUTs are and how QSBS stacking using CRUTs could guarantee more payouts at the end of the term. If you still haven't watched our previous videos on QSBS and CRUTs, I strongly recommend you to do so first. So let's get started. QSBS is a type of investment that offers significant tax benefits to individuals who purchase stock in a small business. One way to maximize the benefits of QSBS is through the use of a CRUT. A CRUT is an irrevocable trust that is typically used to defer capital gains taxes on an appreciated asset sale. It is also a popular tool for QSBS stacking because it qualifies as an individual shareholder and therefore receives its own 10 million QSBS exemption. The goal of QSBS stacking is to minimize taxes and maximize returns. There is a specific structure for QSBS stacking using CRUTs, which includes setting the trust to run for 4 years using a standard CRUT which guarantees a 44% payout of trust assets each year and investing the funds while the trust is running. As an example, let's take Tommy, a successful entrepreneur living in Oregon. Tommy has 20 million of QSBS eligible shares from his business, and he is expecting an exit imminently. He's narrowed down his planning options to 2 scenarios, and he's trying to evaluate the pros and cons of each. Assuming that Oregon taxes are 35% all in federal and state taxes, that the shares are QSBS eligible, meaning 0% upfront tax rate on sale, that the exit amount is 10 million, excluding the additional amount taken as a personal exemption, that the investment growth rate, both inside and outside of trust, is 8% per year, and that the annual trust distribution rate is of 44%. Regardless of the planning choices Tommy makes, his first 10 million of gains will be tax-free. That's why we call QSBS the best tax break around. The question is what he should do with the next 10 million of QSBS eligible equity. Option 1. Do nothing. Imagine that Tommy does no planning for the remaining 10 million. When he sells, he'll owe 35% taxes, federal and state capital gains tax, and the federal net investment income tax. That means he'd keep 6.5 million of after-tax proceeds to spend or invest as he sees fit. If he does nothing after 4 years, assuming Tommy invested the total after-tax sale proceeds of 6.5 million for 4 years at an 8% annual return and didn't take distributions, he would have 8 million of after-tax proceeds, while incurring a tax bill of 4.3 million. That's 3.5 million of taxes on the initial sale and an additional 800,000 of taxes on the after-exit growth. Option 2. QSBS stacking with a CRUT. Now consider what happens if Tommy places the remaining 10 million into a CRUT prior to selling. When he sells, the trust keeps 10 million because the trust gets its own QSBS exemption. Over 4 years, assuming Tommy reinvested his earnings at 8% growth, the trust would distribute 11.28 million of after-tax proceeds, while only incurring a tax bill of 1.2 million. Now, why is there a tax bill if the assets are QSBS eligible? Because Tommy will be taxed on the investment gains of the QSBS exit proceeds as they are reinvested inside the trust, which are about 2.5 million of gains over 4 years. Additionally, the charity of Tommy's choice would receive approximately 1.35 million. The benefits of using a CRUT for QSBS stacking is that it allows an individual to gain an additional 10 million QSBS exemption, which can be reinvested for the long term. Additionally, the CRUT operates on a set distribution schedule, which allows for access to the returns as soon as possible. However, it is important to consider the specific structure of the trust and the tax implications when choosing this method. In addition to the above, it's also important to note that CRUTs have certain limitations and restrictions when using them for QSBS stacking. For example, the trust must be irrevocable, which means that it cannot be modified or revoked once it is created. Additionally, the trust must operate on a set distribution schedule as dictated by the IRS, which can limit the individual's flexibility and control over their investments. In conclusion, the QSBS exemption is the best tax break available to startup founders, early employees, and investors. 10 million of capital gains tax-free. But with a QSBS stacking strategy, you can achieve even greater protection. Using a CRUT for QSBS stacking is a great way to maximize the benefits of the QSBS exemption. All right, that wraps it up. I hope you found this video useful. Now, a quick word about Valur. We have built a platform to give everyone access to the tax planning tools of the ultra-rich like Meta founder Mark Zuckerberg and others. We make it simple and seamless to pick the best strategy, set up and administer these structures at a fraction of the cost of competitors. If you still have any questions, you can visit our website at valur.io. You can read our content on tax planning strategies, play with our online calculator to discover your financial gains by picking different trusts, or schedule a call with us.